Banking activities have started in the Arabs before the advent of Islam, but their operation has the riba element. However, the arrival of Islam resulted in the complete prohibition of all activities involving riba, and this prohibition did not prevent the development of trade both internationally and internationally, and the origin of Islamic finance can be traced back to the dawn of Islam 1400 years ago. However, at the intellectual level in the 1940s, the third opinion acquired momentum. In the 1950s and 1960s, this tendency continued when the first Islamic banks were created in the modern history. This suggests three stages in the establishment of modern Islamic banking companies. The first phase is the concept of interest-free banking. This stage began in the 1900s. From 1940 to 1974, there were 31 published studies on this subject. Muhammad Uzai's research in 1955 was the first work on the subject of non-interest banks. The second phase began in 1963 until 1976 is the emergence and establishment of Islamic banks. At this phase, both intellectual and implementation development was tremendous. The early banks established themselves as pillars for the continued development of the Islamic financial system. The first modern experiment with Islamic banking was carried out in Egypt undercover without projecting an Islamic image to avoid being viewed as a manifestation of Islamic extremism, which was anathema to the political authority. In 1963, Ahmad al-Najjar led a pioneering effort to establish a profit-sharing savings bank in the Egyptian town of Midkamar. These banks are viewed by many researchers as the first banks to have no Islamic society interest. However, due to the political reasons, these banks fusioned with government banks in 1967. In 1971, the Nasser Social Bank was founded in Egypt and declared as an interest-free commercial banking bank after Midkamar had become a conventional system, although its charters did not refer to Islam or the Sharia. More studies on Islamic banks began to emerge in the subsequent years. The third phase is the expansion of Islamic banks in 1977 to present. Over the years, the number of Islamic banks around the world has increased. Many banking companies established in the early 1970s and 1980s continue to operate, particularly in the Arabian Middle East. Examples are the Dubai Islamic Bank 1975, Faisal Islamic Bank of Sudan 1977, Faisal Islamic Bank of Egypt 1977, Bahrain Islamic Bank 1979, Malaysian Muslim Pilgrims Savings Corporation 1983, among others. Moreover, many conventional banks have created Islamic windows and other conventional banks have completely transformed into Islamic banking. In addition, a number of Islamic bodies to regulate and promote the Muslim financial industry have been established. Eventually, the entire financial system of Iran and Sudan was Islamized.
Next, I would like to talk about the principles of banking. The fundamental framework of Islamic finance is a set of rules and laws known collectively as Sharia, which govern the economic, social, political, and cultural aspect of Islamic society, and they are strictly followed in Islamic finance. Islamic finance today is based on a set of prohibitions that are not always illegal in certain countries where Islamic finance is operating. The first principle is paying or charging an interest. Lending with interest payment is regarded by Islam as an exploitative practice that benefits the lender at the expense of the borrower. Interest is considered as usury, also known as riba, in Sharia law, and it is strictly prohibited. The second principle is investing in business involved in prohibited activities. In Islam, certain activities are forbidden, such as the production and the sale of alcohol or pork. The activities are regarded as haram or prohibited. As a result, investing in such activities is also prohibited. The third principle is speculation. Sharia prohibits all forms of speculation of gambling, known as maizir. As a result, Islamic financial institution cannot be involved in contract in which the ownership of goods is contingent on an uncertain future of event. The fourth principle is uncertainty and risk, also known as GARDA. Participation in transactions with high risk and or uncertainty was prohibited under Islamic finance rules. The term GARDA refers to a measurement that assesses the legitimacy of risk or uncertainty in investment. GARDA is observed in the use of derivative contracts and short selling, both of which are prohibited in Islamic finance. The fifth principle is material finality of the transaction. Each transaction must be related to a real underlying economic transaction. The sixth principle is principle of implementing profit sharing based system. According to Sharia, money placed in a bank without being invested should never increase. Rather, it should decrease through the required payment of zakat each year. Because it is viewed as exploitative and encourages capitalism, Islam does not accept interest as a legitimate means of profit making. That is all from me about the Islamic banking principles. Next, we proceed with the Islamic banking products.
Thank you, ESHWAR. So, there are 5 major common contracts that will be used along the process of buying Islamic banking product. First one, gratuitous contract. It is a contract that consists of unilateral contract such as Qard al-Hasan. Secondly, is trading contract or debt-based contract such as Muharabah. And the third one, it is an investment contract for equity finance such as Mudarabah. The fourth one is supporting contract, which is a legal set of written document to support the contract and contractual arrangement that is aimed at achieving a specific goal such as takaful and also sukuk.
The first specific product is Mudarabah. Mudarabah is a partnership of parties, which one party called Rabul Mal, capital provider who will provide money for a commercial enterprise, and another party called Mudarib, entrepreneur who will manage the commercial enterprise. Distribution of profit are based on the proportion of profit that has agreed by parties. There are 2 types of Mudarabah. The first one, Al-Mudarabah al-Muqayyadah, restricted Mudarabah, which Rabul Mal provide the capital for a specific business and place for Mudarib. The second one, Al-Mudarabah al-Mutlaqah, unrestricted Mudarabah. Rabul Mal give full freedom to manage the business activities as he wish, but according to the common business. Rabul Mal can make contract with more than one parties, and for all the losses, Rabul Mal have to take responsibility to all the financial losses, and for the Mudarib, they only take responsibility of their effort and time in managing the business. However, if Mudarib is proven in a mismanagement, they have to take responsibility of the financial losses. Next, the second one is Musyarakah. Musyarakah is a few partners who conducting some of business by forming a joint company where all the partners share of profits and losses. The distribution of profit are by the proportion of actual profit, and the losses are distributed by the proportionate of their investment. All partners can manage the business. Musyarakah are different from Mudarabah. We can differentiate it in terms of the source of capital, the distribution of loss, and the management. In terms of the source of capital, in Musyarakah, all the partners will invest their money into the business as the capital, while in Mudarabah, only Rabul Mal will provide the money for the capital of the business. In terms of distribution of losses, in Musyarakah, the distribution of losses are based on the proportion of their investment, while in the Mudarabah, all the financial losses are the responsibility of the Rabul Mal. And in terms of the management, in Musyarakah, all the partners can manage the business. However, in the Mudarabah, only Mudarib will manage the business. The third one is Murabahah. Murabahah is a form of sales in commodity, where price and cost and the profit margin from the commodity must be disclosed using cost plus financing or cost plus profit basis. Cost plus financing is involved the purchase of commodity by a bank on the behalf of the customer. When a bank buys the commodity and sells back to the customer, there will be added a profit charge in the price for the customer. Next, the fourth one is Ijara. Ijara is to give something on rent. There are two situations of ijara. The first situation is when an employer is hiring an employee to use their services and pay them on their services given, and it shows a term of ijara. The second situation is when someone has been paying rent for a property or car. The property or car will be owned by the person who paid rent, and they have the rights on the property or car. These situations are similar to the leasing. Next, wadi'ah. Wadi'ah is used on the safekeeping, custody, deposit, and trust. Wadi'ah refers to the deposit of funds or assets by a person in an Islamic bank for a period of time. All the risk of the deposited money will be under the Islamic bank responsibilities. In wadi'ah, the customer will deposit the money in Islamic bank and give permission for the bank to use it for generating the profit. And the last one is Qard al-Hasanah. Qard al-Hasanah is an interest-free loan. Borrowers only requires to repay the amount of principals without interest, markup, or share from the business of the borrowers. This shows that Qard al-Hasanah is applied with the Sharia, since there will be no interest or riba.
Insurance is very important to protect ourselves and family, especially to pay for any unplanned incident such as accident and death. So in Islam, it is called takaful. It is based on mutual cooperation where once the buyer pays for the takaful premium, he or she has agreed to contribute their money into a pool system to guarantee himself or herself and other takaful buyer against any loss and damage. So, compared to conventional insurance, takaful operator will distribute equally the loss or earning to all contributors after all claim has been made, and also takaful operator does not take more than their participant receive as their profit. Last but not least, Islamic finance also provides Sharia-compliant bond for Muslims to finance their company, and this bond is called as sukuk. The major difference that can be observed from sukuk and other conventional bond is the way sukuk is channeled into business that does not involve uncertainty, gambling, and haram business such as producing alcohol or selling pork. Next, sukuk is different from conventional bond because it consists of direct asset ownership interest where investors receive profit generated by the underlying asset, while conventional bonds are structured on the basis of debt.
Okay, thank you to my teammates for the great explanation. Now, my name is AFIQAH binti ALWI. I will explain to you about the differences between Islamic banking system and conventional banking system. Alright, so firstly, conventional banking system uses money as a product besides a medium of exchange. Meanwhile, Islamic banking system uses real asset as a product and money just a medium of exchange. What I can explain about this is conventional banking system focuses on increasing the number and the value of money in their company or in their bank. Meanwhile, Islamic banking system focuses on using a real asset such as trades and in the market and uses money as just as a medium of exchange. And yeah, so next one is time value is the basis for charging interest of the capital for conventional banking system. Meanwhile, for Islamic banking system, the profit on exchange of goods and services is the basis for earning profit. What I can explain is conventional banking system uses the time basis interest. Meanwhile, Islamic banking system uses a profit earning asset and trades in the market to earn their profit, which we can see that it is more fair for Islamic banking system because if as a person that has a difficulty on gaining more money and if we loan, for example, if we loan from the conventional banking system, the more time we take to return back the money that we loan will only put us back into a same situation and will only increase the amount that we have to pay. Meanwhile, Islamic banking system does not use interest and they only earn profit through assets and trades. So next, the difference that we can see between conventional banking system and Islamic banking system is that in conventional banking system, the debt financing gets the advantage of leverage for an enterprise due to interest expense. Meanwhile, in Islamic banking system, the sharing profits in case of mudarabah and sharing in the organization of business venture in case of musyarakah provides extra tax to the federal government. This leads to minimize the tax burden over a salarized person. Alright, so in conventional banking system, the debts usually gets more and more, just like what I said. When we loan something or we borrow some money from the bank in conventional banking system, the debts get more and more, and they will be charged with tax from the service charge, from the interest charge, and so on. But in Islamic banking system, the tax charge goes only to the federal government, which means that the borrower will not be burdened with so many extra charges. That is why it is better for us to choose Islamic banking system. So the differences between conventional banking system and Islamic banking system is that in conventional banking system, there is a fixed rate of interest being given to the depositors. Now, this might sound good to you because the more we deposit, the more we keep our money, then the more we will get back. But actually, it is the same thing for loan and debts. So the more we borrow, the more we have to pay back, right? And for Islamic bank, profit are distributed out of the profit earning by bank for the month as per decided weightages. So, for example, I keep 5 sugar bags in the bank, but the bank only uses 1 bag of mine to be used as the profit earning trades. So when there is a profit gained from the trades, the Islamic bank will only pay for the amount that they borrowed, right? According to the weightages that they borrowed. So out of the 5 bags that I've kept in the Islamic bank, I will only get profit out of the 1 bag that they use, which means it might sound less profitable, but in the eyes of Islam, it is actually much more honest and halal. So in other words, Islamic banking will not put any fixed interest either in debts, either in loans, or in anything. So that the consumers or the users of the bank will not be burdened with any kind of interest. So that's all from me.